This is a Stock Trading Reality Podcast, episode 181.
I know what I'm good at and I know what I need to learn. So I'm not going to throw real money at a 5-minute chart and take a 4-digit loss because I missed something on a level 2 or I missed one small candle of volume that actually made up 30% of the trading volume for the day.
This is the Stock Trading Reality Podcast, where you get to see the realistic side of a trader's journey. Get inspired and stay motivated by everyday normal people who are currently on their journey to trading success. He loves to split firewood. Want to come to my house? Clay Trader.
Yeah, cutting wood, splitting wood, whatever you choose to call it, it's great. And now that I kind of think about it and reflect as I record this right now, not only is it therapeutic, and that was kind of the main reason why I like to do it, but I think it's therapeutic because it's not mindless because you don't want to cut off your arm, right? But it's also just healthy. I mean, swinging the axe, getting through, it's going to get your heart beat up, and it's from a strength building perspective, endurance perspective, assuming, of course, you're not taking a 10-minute break between each one, then yeah, it's quite healthy. And then also it's very practical, whether you have a wood-burning stove or something that warms up a room in your house, or maybe you have a pole barn or what have you, or if you're just having a bonfire with friends and need some wood for that, the results of splitting the wood are actually quite practical too. So for me, I'm a big fan of it. I think it has all sorts of benefits. And like I said, therapeutic was the main one, but there's a lot of other good things that come from it. Now, am I any good at it? That's a whole nother topic for conversation. My father-in-law and my brother-in-laws who grew up doing it, they're like the great men of the North. They're like Vikings or something. They just show up and they just make it look like a warm knife through butter, very efficient. And then me, the city boy, shows up and I do my best, and I'll just leave it at that. But I find it, I like to do it. And if you've never done it, you should at least try it one time in your life. It's a good time for sure. Now, for our guest, I am flying solo for this interview, and I'm assuming by the thumbnail you saw that this is part one. So therefore, yes, this is going to be a two-parter, and this episode will go through half of our discussion that I had with Mike. What is his alias in the chat room? I'm not even going to tell you that right now. It'll make sense once the interview starts, but I'll just say it's kind of an artistic name. It's up for interpretation. So I'll just leave that as it is right now. But before I get into the interview, Mike, I really commend, I really respect. He is one of those guys. He's very successful. He's very intelligent. He knows how to trade. He knows how to put together a trade plan. However, just as a little context, he is a member of Clay Trading University, and part of Clay Trading University is we have weekly live webinars. And not every week because Mike travels and has work stuff, but I would say the vast majority of the time, Mike is on these live webinars, and part of the webinars are I'll ask questions, try to make it, them interactive, kind of live quizzes, and just kind of, spice things up. And no matter how basic a question I ask, can you guess one of the people who's answering? Mike. And it goes to show, and it's an underlying theme for him, but he's one of those guys where, he's firing on all cylinders. He's got a sharp axe, but he wants to keep that axe sharp. So he by no means is walking around with an ego thinking, hey, I know what I'm doing. I got it. I'll figure it out. I'm too good for these questions. I'm too good for these webinars. Why would I need that? He could think that. And I wouldn't be offended. I'd say, hey, yeah, you know what you're doing. That's totally fine. But it's just his mentality of, you know what? Yeah, I got it. I get it. My axe is sharp. I want to keep it sharp, though. And the way you keep it sharp starts with the fundamental. So I don't care how basic these questions Clay's asking, because remember, the live webinars have other, newer people on them. But I'm going to answer it. I'm going to treat it serious. I'm going to pay attention. And I'm going to, go through the questions, the exercises, what we do in the live webinars. And he's there doing it, no matter how basic it actually is. And that's just inspiring. That's a good example, not only for me, but really just anybody, to show that, you're never as good as you probably think you are. Your axe is probably never as sharp as what you think it is. And a great way to just try to keep yourself, on the A game is to always be humble and always, be open to the fact that maybe you can always brush up on some fundamental stuff just to make sure that you're understanding things the way that you are. So Mike is a great guy. We had a great conversation. In fact, I've already invited him for my Money with Clay podcast, which is my other podcast that I have for more of a long form podcast that I want to sit down because he's a, like I said, successful guy. We go down all sorts of fun rabbit holes. So without further ado, let's hear, remember, two-parter. So part number 1, let's get started with Mike. Mike, welcome to the show.
Hi, Clay. How are you?
Good. All right. First question. I'm looking at your name right now in the chat room, and I look at it as, in my mind, it reads as a froggy. Am I reading it the way you intended it to be read, or what exactly is your alias?
Oh, that's funny. So when I was in college, I needed a front end to my webmail. This is in 96 when you would go to the computer lab and they asked you to change your student number to something else. And I didn't really have a nickname, and I wanted something that wouldn't directly attach to me with my actual name. So that was something close enough that I could remember, and it's stuck for 20 some odd years. So how it's pronounced, what it is, there's not really a background story to that. It's just, it is what it is.
Okay. So, I mean, it's up for interpretation is the moral of the story.
It is, and it's a good conversation piece because you could read it as a froggy or afrogy or afro. So It's a conversation starter in the chat room, I guess.
Yeah, for a while my mind computed it as Afro G, but I don't know, somewhere along the way it converted over. Maybe in like the live webinars or something, it turned into I don't know. But your point has been proven. It is a good conversation starter. But I'm glad I'm not. It's kind of like a piece of art. It's make whatever you want it to be. So you're an artist apparently too, in the way you structure just the English language.
I started as a music performance major in college, and we'll get into that a little bit, but I should probably trademark it at this point because if it shows up in a rap song or something like that, I could get very rich very fast.
Yes, I think you're on the right track with that. But a little bit before we got started, I'm just going to call you Mike since this art, because it'll get too confusing if I'm calling you Afro 1 second and then G and then Fro and then Froggy. So I'm just going to call you by your first name, Mike. So that's Mike, fine. we were talking a little bit beforehand, and you mentioned that this all started when you were 6, that being the markets and all that. So for you newer listeners out there, the first question always is, where did you first hear about the markets and kind of what got you interested? And Mike alluded to the fact that it actually started at 6. We didn't go any further than that. So I guess we're picking things up from age 6. So yeah, age 6, that's crazy.
Yeah, so before I get into my backstory, let me overview the next section a little bit. So I'm going to talk about lifelong and intentional learning, and that'll take us from 1984 to the early 90s, and this will all make sense a little bit. Then I'm going to talk about my missteps on the market when I was in college, so lack of discipline of what I learned. And then the third section, when I left college and started rebuilding all of my accounts and businesses, grounded realism. And so those are the 3 pillars that I use not just in trading, but in life. And that's been successful for me, and hopefully get something out of this as well. So my story in the market, oddly enough, starts in 1984 when I was 6. And that sounds ludicrous to most people, but I remember we were living in Illinois at the time. We moved around quite a lot, and my old man was a pipeliner. My family's been in the oil business for a very long time. But in 1984, I was sitting in front of a TV, and I was watching some random show. I don't remember, but I remember that I started having a big pain underneath my abdomen, which became appendicitis. And that is something you remember. If you've had your appendix removed, then you remember that as a very crushing pain. And in the 80s, that was a 3-day surgery, and you had to go home recover for the final day. So where I got into the markets was remembering that pain. And the third day I was watching TV at our house, and for some reason I started flipping through the channels, and I remember directly there was this channel that had this blue scroll and this white scroll at the bottom, which I came to find out later was called the Financial News Network, which today is CNBC. And so my introduction to the market started by watching those 2 ribbons go through, and I was, for some reason, just entranced by seeing these fractional shares keep going through and seeing them move. And I thought, well, that's kind of interesting because you're watching this news network and people are talking about money, which I knew what money was. I knew how to go spend it and Walgreens or Woolworth, whatever you might call that. But did that and got hooked a little bit by just watching that every day. So if you see me in the chat room, the other thing I used to watch back in the 80s was Press Your Luck, right? And so it seems like every third meme I throw up on the chat room has something to do with Press Your Luck. That's where that comes from as a sidebar.
Yep. Interesting.
Yeah,
nice.
So I did that. And as I mentioned, we moved around quite a lot. So as I was growing up, I found very quickly I was good at math and I liked reading. And I like sports and I like music. I'll get into those later on. But math and reading are two things I really like. So I started reading a little bit about what this, quote, FNN network was with my dad. And my dad has been a good coach in my financial life over time. And I'll talk about that later on as well. But regardless, through that reading, through learning math, putting an emphasis on that over the next 3 years, I started picking up what the market actually was. And that's not to say I was investing at that point. It was just more learning about to learn. And so by 1987, we had moved a couple times. We were living in the panhandle of Texas. And if you've invested for a long time, you'll remember Monday, October 19th, 1987, which was Black Monday. And I remember, I'm in third grade now, so I'm 9. I remember that I was at a friend's house and they had just bought this big trampoline, and it was an afternoon, as I remember, but everybody's out there playing around and whatnot. But I walked into the house of my friend. I saw those blue and white scrolls at the bottom, and the guy's father taught me some new 3 and 4 letter words that have scarred me to life today. But I remember the whole screen was just red, and he was talking about all this money he lost and whatnot. And I thought, well, that's interesting, because if you can lose money watching this FNN thing, maybe you can make money doing it too. And so it started triggering in my mind that if you can just sit there and watch TV and make money, and remember, I'm in third grade, so there's still a lot of innocence there, but if you can watch TV and make money, well, that sounds kind of fun, because my dad at the time was working 12, 14-hour days. He's traveling a lot, and a lot of my friends, they're working in the oil patch out in the panhandle too. That didn't look as much fun as sitting in the air conditioner, drinking a tea and making money, staring at a computer screen or staring at a TV. And so I put that in the back of my mind. And then a couple years later, my dad was working on a master's in a business degree and completed that at West Texas State, which is West Texas A&M now. And that was my first foray into understanding that you could actually get an education in business and make money at it. And so by 1989, we were still living in the panhandle of Texas, and I don't remember what day it was, but one of the summer days, we went down to the library, and I'd mentioned I like to read a lot. I walked up to my dad, and he had this big 3-ring binder open, and he was just flipping pages. And I looked at it for a second, and it had these charts on them, and they had a lot of words and numbers, and they had these same tickers that I had happened to remember on TV. And I started asking my dad about it. And I found out that they were value line reports. And that was my introduction to analysts, and that you could actually look at the historical prices on a market and see how money grew in the market over time. So that was my first foray into investing.
Is value line, is that where you'd find like the charts too at that point? Or is that something totally different?
Back then. No, back then that was. So back then you had analysts that would tell you about stocks, and we can talk about that later on, but you'd have analysts tell you about stocks. You'd have money guys from Merrill Lynch or Fidelity, or those type of companies that would pitch stocks, and you had Value Line, which was the real version of the truth. And it cost an exorbitant amount of money to day trade back then. So most people just swinged or they invested, right? If you're day trading, you're actually on a pit doing day trading, or you're at one of the big banks. And that was way beyond my knowledge at the time. It was just stuff I've learned over the years, right? So I learned what a chart was, and I learned what a stock was, right? And so at the same time, my parents had put me into Cub Scouts, and I started learning things outside of school. And by 1990, we had moved to Nebraska, and I was well on my way into Boy Scouts, and I took a personal finance merit badge class, which taught me more about money management, investing, whatnot. So by now, I'm 13, 14, I'm starting to get some decent knowledge as to how money works. I'm by no means ready to trade or anything like that, but at least I have a layman's understanding. But at the same time, I had decided that if I wanted to do other things in life, and that meant playing sports and trying to impress teenage girls, because at this point I'm a teenager, then you need money to do that. And so I had learned that a couple of my neighbors needed help mowing their lawns. And so I talked to my dad about that, and he allowed me to use his lawnmower to mow their lawns and my dad's lawn for $13 per lawn per week, so $39 a week. And so I started saving.
How long did each lawn take?
Oh, maybe 20, 30 minutes. So,
okay, so that's not bad at all.
No, not too bad. Now, if you look at what I'll call bang for the buck or return on time, yeah, it's not too bad. And also, you're living in Nebraska, so you can only do this about 8 or 9 months a year. And it's a small town, Nebraska, 10,000 people. So in 7th grade, it's not like you're going to work at the local McDonald's or the local Wally World or Tractor Supply, whatever. There's only a few ways you can make money. One of them is the typical American dream of mowing lawns as a teenager, I guess. Right. So
that's good stuff, man.
So
good stuff.
Yeah, so I did that, and I kept saving money. And by the mid 1991, I've got about $1,100, and it started to click on me that I can take that $1,100 and I can throw it in a bank, and they'll pay me a little money. Or maybe what I should do, going back to those value line reports I looked at in 1989, is maybe I should put it in the market. And I had no idea what commissions were or what a stop loss was or anything like that. I just knew if you threw it in and you looked at it 10, 20 years down the line, you were solid gold and you're just going to make all sorts of money, right? And that always holds true until you start looking at stocks like GE or Pets.com or whatever. And we'll get into that in a little bit. But regardless, I talked to my dad about it, and I had no idea how to research a stock, but he told me, here are some things to look for, and I'm going to narrow the field down to 5 stocks for you. And once you pick one, I'm going to teach you how to look at a stock going forward. And so out of those 5, I don't remember all 5, but I remember GE. And so for $1,100, I shoved all in on GE and made my first trade in August of 1991. And if the story stopped there and I would have sold in 2015 before all this racket that GE's happened today, I would have done very well. But unfortunately, there were some learnings from that. And so the message for those first years is the lifelong learning aspect continues and is impressed very early on in your age. Hard work is pressed on very early on your age too. And what kills investors in my mind is they're not willing to put into sweat equity to learn. And they look at a stock and think if they shove all in on one thing, then if they hold for 10, 20 years, that money's going to be there. And there are no guarantees on the stock market. If you fail to learn, then the market will teach you some tough lessons. And if you fail to hustle, the market's going to teach you some tough lessons too. So if you don't take anything away from this podcast other than learning, that is the one thing I would tell you you absolutely have to take away as a trader or an investor is lifelong learning. Never quit doing that.
I fully agree. I'm trying to, out of curiosity, what did you get G for back then? What was it? I mean, I'm sure there had been plenty of splits since then also, but
I don't remember for sure. I want to say it's like $9. Yeah.
Okay.
And I tried to pull up a chart. I don't even remember the exact day. This is almost 30 years ago.
Right.
So paper fades or things go missing or you move 10 times. So I don't remember the exact amount, but I want to say it was $9. So even with today's erosion on GE, I'd still be green, but 30, I don't remember what GE is trading at, $15. So if you got a $6 appreciation, which is 67% on $9, you did not beat the S&P 500, which means you got killed by alpha, and that's the last thing you want as a trader.
Right, and plus G's at $12 right now. So
okay, 12.
Your argument became that much stronger.
Yeah. Okay, so So by 91, I made that first trade, and I realized, well, I can keep mowing lawns, and I can buy a set of golf clubs because I wanted to play on a golf team in junior high and high school, and that was mainly to skip track when I was growing up. I'm just not a fan of running wind sprints beyond what I have to. So I bought some golf clubs with some of the money that I was making from mowing lawns, and just continued to learn over the next few years. So things that impressed me over the next 5 years, if you've heard of Warren Buffett, so where I got introduced to Warren Buffett, and this got me really going on fundamental analysis, which is not trading, so I'm not going to get into that too much. But Warren Buffett bought a business called Nebraska Furniture Mart back in the 80s. I think it's 82 or 83. But by 91, there were a few documentaries that were out. And living in Nebraska, and Nebraska Furniture Mart is in Omaha, I wanted to learn how Warren Buffett got to buy a furniture company without looking at anything the furniture company did. All he did was shake hands and buy the business. And what I started to learn in the business world is your word of mouth or your handshake, your reputation is everything supported by facts. And so I started to study Warren Buffett on that item because I thought, well, if I'm mowing lawns and I want to build that business a little more because I want to make more money, because I want to buy better golf clubs and I want to be able to go out on Friday night on dates when I'm in high school and whatnot, well, then I need to make more money to do that. And so I started researching Warren Buffett, and I learned about securities analysis a little bit. And that's not to say I was an expert on a balance sheet or a P&L, but I started finding out what they were. And so that started teaching me more about understanding analyst opinions, understanding charts at a very high level, not the candles that we talk about in the chat room or not, but understanding what SEC financials are, and understanding that there's value that if you can teach yourself how to read financial statements, and over time as a value investor you can make money, which is that buy and hold theory on GE. So I'm still holding GE. We move again to Texas. So this is the second time I've lived in Texas now. I keep working through high school. So I'm working in a Piggly Wiggly. I'm making $4.25 an hour, which is not what I was making mowing lawns. But in the city that I lived in, mowing lawns would have been very difficult. But by working at Piggly Wiggly, I was also able to spend time studying in high school, getting good GPA, getting a good SAT score. And by my senior year, I had been admitted to a few universities, and I think it's decently known from one of my avatars that I ended up going to Mizzou. And so by the time I got accepted, I decided Piggly Wiggly was fun. I needed to find something that makes more money for less time. So I started umpiring baseball games, and that paid $20 an hour back then. So that started giving me some more cash flow to think about how to make money for investing. And so you would try to umpire 2 nights a week. That'd give you $40 for 2 games. And then you try to umpire 4 games over the weekend. That's $80, which in high school in the 90s is tall cotton. And so that's $120 a week. You sit there, keep collecting that cash, and you would continue to save it or try to invest. So over these 5 years, I'm building up for a high school student, a decent portfolio. I've got maybe $5,000, $10,000 in it at this point. Sitting here, just continuing to buy more GE, buy a couple of other blue chips. IBM was another one I think I got into, but continue building that up. And then in 96, when I graduated, I decided, I had been playing trumpet for a while. I had done pretty well doing that in high school. I want to be a music performance major. I'm going to go play with the New York Philharmonic in 5 years and be a prodigy, and I'm just going to make all of this money. And so it's nice to have goals, but the goals need to be based in reality. I did that.
I got a quick question. So in high school, you were building your portfolio. Was this just all still stemming from back when you were a kid and everything you've explained, or did you have buddies that were doing it, or were your buddies looking at you saying, "What are you doing? What are you putting your money in? You're building a portfolio. What's that word? Why aren't you spending it on all this other stuff?" Or were you in a little club, or are you just doing this totally on your own?
A lot of this was on my own and through my dad. And so,
awesome.
So my dad at this point had become a superintendent for, I think he's a superintendent, but a superintendent for a pipeline company and a compressor station. And remembering he had an MBA and that was based in finance. I was learning a lot from him, but also a lot of it was just sweat equity, trying to teach myself how to hustle and make money. Because again, the whole goal to this is to sit in front of a TV and make money,
right?
Passive income.
Right.
It's not, and don't take away. I'm sitting here on 10 businesses, and I've got a 10-digit portfolio. I'm a billionaire at 18. That couldn't be further from the truth. What it is making a little money and trying to make a little more return on the market than what you can make in a bank, because that's what smart money does. That's all it is. And so I had done that through 96, and then I went off to college, and everybody knows the siren songs at college. You can go party and whatnot. And so the first year and a half I did okay, and thankfully, because I was in the marching band and doing all of these music classes, I had a pretty good GPA, but my academics, the hard classes, were starting to erode. And so by the second semester of my sophomore year, I had failed history of Western music. I took a D in music theory, and I still had a 3.0 that semester because of all the music classes I was taking. But that was a big wake-up call, because it made me realize that I'm never going to be a music major, but I need to find something that makes money and something that I can be good at. And so I thought about that for a while. And my uncle was a partner in a national accounting firm in St. Louis, and he had convinced me through some coaching to switch my major from music performance and education. I'd bolted that on to finance. And so I flipped to finance the second semester of my sophomore year, continued that for a little bit, and then I realized, well, I could do that, but then I'm going to have to go get into the best MBA program I can. And because I screwed around my first year at Mizzou, I don't have the GPA to get into one of the top flight MBA programs at the time. And so he convinced me to flip to accounting. And so for the next 3 years, this is 1998 now, for the next 3 years, I'm studying hard to become a CPA. I'm working toward a master's of accounting. During the summer, I'm umpiring baseball games, again, making that $20 per night each night during the summer, trying to get a couple of the fail out courses away during the summer. So, sweating hard to get through all of this. And by 1999, I've got a pretty good portfolio. Because if you've looked at the stock market, you think about the dot bomb era, 98, 99, 2000 were pretty good, or at least early 2000. And so I'm sitting here just printing money, and I start hearing the siren song of tech stocks. And so tech stocks back then are Yahoo and whatnot. So I thought, well, I've been making okay money in GE and IBM and Ford, but I could be making really good money if I went and bought tech stocks. And so I started morphing my portfolio from blue chips to a tech stock portfolio. And I knew that was a little risky, but I also thought, well, I'm only 19, 20, 21. So if this blows up, it'll suck, but I'm early on in life and I can take that hit knowing that I've got 40 years to work and rebuild everything. And unfortunately, I was still a fundamental trader at the time, not a technical trader. So I knew a little bit about charts, and I was starting to take some portfolio classes and a derivative class at Mizzou, but I didn't know anything about technicals. And what woke me up to technicals was the dot bomb era, where I watched PMC Sierra and Sienna Corp, which were two of the companies I bought in, completely crater. And when I say completely crater, 90% loss. And unfortunately, at that point, I had started to surround myself with some, quote, traders. And in hindsight, they didn't really know what they were doing. But they kept telling me, well, if you hold on, be long and strong. I'm sure you hear that word on random websites, but be long and strong. Strong hands. Yep. It's coming around. And so I remember specifically, I rode PMC Sierra from 250 to, I think, 16 before I finally let it go, which put a big dent in my portfolio.
$250 to $16, right?
Yeah, per share. That's right. Okay. Yeah. And Sienna, I don't remember the exact prices. I think I'm probably off because I didn't look at the chart. And again, this is 15 years ago. I've slept a little bit. But I think I rode that from 38 to 10. I don't remember the exact price, but it was a good 70% hit. And so my portfolio got hit pretty hard during dot bomb. It didn't go to zero, thankfully, but it got hit. But the good news was, because I listened to some mentoring from my uncle and my dad, that I was about to graduate with a master's in accounting, and I needed to pass the CPA exam to get a job. And so going back to that lifelong learning and hustle, I was able to flip around my lack of discipline and pass the CPA exam the first time out, which that doesn't happen very often. Not trying to toot my horn. It's more an example of hard work gets you places. And so I was able to rectify those errors on the market by at least getting a decent job coming out of school. And when I came out in December 2001, this is when Enron's blowing up and Tyco and Dynegy had some significant issues. Was MCI WorldCom. Yeah, all these companies are starting to have issues on top of .bomb. So it was not a good time to start looking for a job. But it was a good time to think about starting over and giving my life a hard review as to where I'd been in college and what I'd learned over the years. So I flipped from my lack of discipline to a grounded realism. And what I mean by grounded realism is you surround yourself with mentors. You surround yourself with what I'll call winners, people that are trying to go to the same place you are, and they may be further along or not as along, but you're all rowing together and you learn from each other. And that's a lot better way to learn than it is to pay for the real estate yourself, like I was trying to do in the late 80s, early 90s. And so by 2001, I graduated from Mizzou. My parents had moved to Houston at that point, and I knew the Houston market wasn't great, but it was okay. And I knew there were a lot of oil companies, and I was starting to get interested in energy finance. And I wasn't able to get a job in finance, but I was able to get a job at a local CPA firm, which is probably one of the best things that ever happened to me, because that forced me to learn more than just financial statements. I learned things around tax and financial planning, some fraud, unfortunately, so doing fraud procedures. I learned a lot of different things and basically became a consultant, which is what I've more or less done my entire career since 2002. But by doing that, I was able to retool myself and start over. So I started saving money again. And back then, a CPA with 0 years experience made $40,000. And I actually moved home for a year so I could save even more money. So did that for a year. Then I moved out, joined a Big Four firm at the time, PricewaterhouseCoopers, and started learning more about markets. The issue with PwC, though, was because I was at a large accounting firm, I wasn't able to trade as much because of certain independence rules that you have to follow as a CPA. You can't invest in a company that you audit, and you shouldn't invest in a company you're consulting with, which, that makes sense. It's one of the major rules in the market. But I was able to begin fundamentally investing again. So I found some companies and started investing in those. And over the next 5 years, I'd built up a pretty decent portfolio again. I chose in 2008 to leave the firm. At PwC, though, I was able to, and fortunate enough to help a couple companies go public. So I built an understanding of how a company goes through the IPO process and what a good IPO looks like versus a penny stock or a SPAC IPO. And that helped me understand what investors, traders, the street, the SEC, bankers, lawyers are all looking at when they start looking at stocks. So that was a good grounding to start understanding what Kool-Aid actually is and to interpret it how you look at Kool-Aid. Right, and we'll talk about that in the next part coming up.
I got a question for you. I'm curious. I'm curious on your thoughts. So I've heard, and I don't know. I kind of believe it. Maybe let me put it this way. I understand the perspective, but I've heard that only bad companies go public because they're only going public because they need to raise money. I mean, what are your thoughts on that?
Yeah, that's not true. So You go public for a few reasons. One is that your equity or your shares is a currency, right? And so to unlock that currency, you can either take a company public so it trades, and then you can more easily buy companies with your currency. We call that a shelf registration. And you can do that after you're a seasoned filer. Or you can do it to unlock value that banks don't see. Or you can also do it as a threat to your industry to take another incumbent public. And so what you'll see is companies run two paths going public. One, in that they actually intend to take a company public, or two, it's a ploy to get an S1. So an S1 is the filing that you put together in front of the SEC that takes you public. But you'll write that S1 as a sales brochure for public companies or large private companies that may be interested in buying you, but you write the S1 to show them if you don't buy, this is what it's going to cost you putting an additional competitor out on the street. Right? And so you'll see some companies go all the way, or you'll see them unlock value because they either don't like the bank financing they're getting, or the private equity company that owns the company wants out, and the best way to do it for value is to take it public, or you need to unlock family wealth, and so you take that public. There's multiple reasons why, but there are bad reasons too. If you have a company that for some reason can't get financing and the only option is to take it public as an option of last resort, you do see that from time to time. The issue with taking that type of company public is that there are significant costs to staying public. Now you have to file quarterly financial statements. You have to be compliant with the Sarbanes-Oxley Act. You have to deal with analysts. You have to deal with large blocks of shareholders. Depending on what type of company you take public, if it's a larger company that has mismanagement, but it's got good assets, you may have to deal with activist investors. And so going public, it's a double-edged sword in that one side, you can make a lot of money doing it if you're holding the stock, or if you get in on day one on a good investment thesis or good equity story, the terms we toss around the street, then you can make money there too. But you can also lose your shirt if you get into an IPO where the underlying assets or the underlying financials are trash, and the street knows that, but you don't. There's different reasons why you go public. You can also go public on different exchanges too. So just because you're a U.S. company doesn't mean you can't go public in Toronto or London or the Netherlands. And there's reasons to do that too. Sarbanes-Oxley avoidance being one of them. But there's different strategies to take different companies public. What I would advise or think about if you are considering investing in an IPO is looking at the underlying equity story and asking, as a customer or a long-term investor, does that thing make sense? If the answer is yes, then I'm not your financial advisor, and I'm not certified by FINRA to do that, so I can't tell you what to do. But based on your version of your portfolio, you would make a decision at that point whether there's an investment thesis you would follow or not. But that's all fundamental investing, not trading. And so for the people that probably listen to this podcast, if you're a trader and you're looking at 5-minute charts, you really don't care about an IPO. You're trading the hype, and we'll talk about that as we go. But if you're a fundamental investor and you're going to stay in something 3-5 years, and you happen to get on the wagon for a mispriced IPO, think about Facebook as an example, when it dropped from 39 to 13 a couple weeks after it priced. You taste the Kool-Aid and it doesn't taste very good. So you put that aside, and a couple weeks later, maybe you taste it again. This time it's spiked with sugar, all aboard.
That's good stuff. Yeah. Because sometimes that Kool-Aid, you grab, you think it's yellow Kool-Aid, but it's not. It's never mind. We'll let we'll connect the dots on that one. So, all right. So point being, the broad statement, look, companies only go public because they need to raise money. That's clearly very false. And I think you did a very good job of explaining there's many other reasons to do it. So sorry to cut you off there in your story, but do you remember where you were?
Yeah, I do. So,
okay, perfect.
So at this point, I helped take a couple of companies public. I did some shelf registrations. I did some M&A, and all this is an auditor. So I'm not actually doing it, but I'm auditing what the company's doing. So I'm learning on the fly, but picked up a lot of stuff. And by 2008, if you invest in oil, you know that oil was on heavy Kool-Aid, meaning we had over $100 per barrel oil prices. So if you remember 2008 and you were filling up your car for $4, thank you very much. My bonus from my employers at the time is very appreciative of that. So at 2008, I decided, well, I want to get in on that hype train because that's going somewhere. And so I left the Big Four to go to an oil field services company to help take them public. And that was in August of 2008. And I remember that distinctively because the third day I joined, Hurricane Ike came through Houston. And so that put a damper on starting the IPO process. But we also hit the high oil price of $141 a barrel at that time. And we rode the curve from 141 down to 30. So I got trapped at that company for a while. And that was good because then I had to learn things about business development and how to stand up a back office and how
I gotta cut you off. I gotta be rude because I love I think you just do it because that's just how you're hardwired. But listeners, do you notice what he said? So I got trapped in that company from 140 down to 30, but that was actually good because, and then what did he start to list out? He started to list out things he learned, which goes to his whole premise of learning, always learning. So props to you, because talk about not playing the victim card. I mean, some people will be like, oh, I'm trapped. Oh, what's going on? But think about that, listeners. He totally is like, well, that was actually a good thing I got trapped at a company because he could learn more. So again, sorry to cut you off and be rude, but that's people. That's the type of mentality you need to have out there. You can't play the victim card. Look at the, what is it? Look at the glass as half full. Or as you would say, Mike, just better than a sharp eye and better than a sharp stick in the eye. There we go. I can never get your line right. But anyways, Sorry, you pressed my adrenaline button and I had to be rude. So I'm sorry, but I'm not sorry. Anyways, keep on going. That's good motivational stuff.
Yeah, so at that point, I had to retool myself, and so I decided I wanted to learn some areas that weren't accounting or finance, and so I also learned investor relations, I learned strategy, I learned financial planning and analysis, and those are a lot of good areas because it wasn't traditional accounting. And so by 2009, I got married to my wife, and that's been very, very good. She puts up with me, and it takes a special person to do that, so she's
Bless
great.
her heart.
But she worked at Merrill Lynch at the time. And so a lot of the restrictions I had at PwC started coming back on. And so I was able to do swing trading for about 6 months while I was at this oil field services company. And that worked out pretty well. But I had to stop that and become a fundamental investor again because her bank had a subjection to FINRA where if you bought something, you had to hold for 30 days. And so that led me to buying equities and then buying puts underneath the equity and then also selling calls in certain cases. You'll hear about covered calls if you start researching options. That's a very normal strategy for fundamental investors. And then buying the puts is more to lock in a base loss or a profit target if you want to hold stock longer term. So I had to do those things, which that meant investing was very expensive. So I did that. And then the following year, I moved to BP right in the middle of what we called the incident in the Gulf of Mexico, or the oil spill, which is what you'd hear on the news. So I had great timing there too. But I did that. That, again, was a good opportunity because I learned how to manage a company through crisis. I learned how to be more agile in strategic thinking versus finance. And so I did that for a year. And then I started looking around the org chart. And I saw my boss at the time, who's probably the best mentor I've had in the accounting and control space. We're still good friends today. But he had an MBA from Northwestern. And I looked at his boss, and she had an MBA from Northwestern. And I looked at her boss, and I think he had a big MBA, but he was also a big shot partner in a big four firm. So I decided, well, if I want to move up, I need an MBA. And I approached him and said, well, I want to go do my executive MBA, going back to I couldn't do that in 2001, 2002, because I didn't have the grades to go to a big school. But I had the background to do it as an executive MBA in 2011. And so I said, well, I want to go do that at Rice. And by the way, I think you guys should help me do that. And they said, yes, we'll do that. So I went to Rice, did my MBA in the executive program, and concentrated in finance and strategy while working at BP. And at BP, I wore a lot of different hats. I did some learning and development, wrote financials, helped do some M&A. I did a lot of different things worldwide, but it was very eye-opening because it changed the way I think from being an accountant or just being a fundamental investor to thinking more about, well, how does a company work and how do people react on the street to how a company works. So by 2014, I had completed that MBA. I had worked at BP for about 4 years at this point. And I decided, well, if I stay at BP, I'm not sure how long it's going to take to continue moving up into corporate world and learning, but I can move back to Big Four and work in consulting. So I went back to another Big Four firm, and I worked in deal advisory. And my area was accounting, finance, standing up companies, and IPOs, those four. So I did that for a few years, and that taught me more about the street and becoming much more eye-opening to how parties interact on the street together and what Kool-Aid actually means in interpreting Kool-Aid. We'll talk about that in a moment, versus how stock prices move. My issue there, though, is I was still handcuffed by the now not only the FINRA rules, but also the AICPA rules. So my trading at this point was heavily fundamentalist or long-term call speculation, or you could call those leaps when you buy a call that's over a year. And so I would do that, and I did okay during the run-up, and then I decided in the last year or so that I didn't want to be a partner in a big four firm. And what I really enjoy is doing consulting, but with energy companies. And so I left for this opportunity I have right now to help turn a company around that's in the energy space. But by leaving, and my wife has since left Merrill Lynch, that has unlocked, for the first time since really 2003, the ability to trade anything and everything I want, except for the companies we work for. So I've been very active, again, rebuilding my portfolio to more of a technical trading background and moving from buy and hold to swing trading 2 to 4 weeks, doing complex option strategies. So if you're in a chat room, you probably see these weird curves that look like 2 tent poles, or you might see something that has 2 or 3 hockey sticks on it. And that's a lot of stuff I've learned over the years, either through my studies through college or watching other people, or on watching other people trade on Clay Trader, different things like that. And so in that journey in 2016, when my wife had left Merrill Lynch, I decided, well, I need to start retooling to become a technical trader again, since I know how that works, but I haven't done it in a long time. And there's another person that's a member of the community in Houston that had done some trading, and he was becoming pretty successful. And we used to work together at PwC a while back. And he had told me about Clay Trader. And I said, well, for that price, that seems a little heavy, but that might be in the ballpark, and it'd be a good refresher regardless. So I'm just going to take the dive and see what happens. So I plopped the money down, did all the courses. Is pretty good. Learned a lot of things that I hadn't seen in a long time. Got some new concepts that that made me think about the market in a different way. Some of the stuff with the background I'd seen before, but no, it was good, and that helped me get into that grounded realism again. Though that I've learned a lot in life, and I've been very fortunate in the opportunities I've had, but I also have a lot to learn too. And the moment that I become conceited in that I know it all is the moment I'm going to get felted again on the market, or the moment that I'm going to get blown by somebody in corporate America. So you have to stay hungry, and you have to stay humble. You have to continue to learn, but you just have to be realistic in what you're trying to learn. So that's been my journey over the last 25, 30 years. I know it's weird that I would start as a tyke and learn what the market is to get to where I am today. But what I would tell you before we get into strategies and trading and whatnot is, if you have people around you that are your friends or your family, or you have kids, the sooner you can move them into a learning environment and you can bring them up on what finance is, not just investing and trading, but personal finance, you'll find that people that learn what personal finance is early on are very successful in personal finance later. And not everybody has that opportunity. Some people learn it as adults. Some people never learn it, and they make excuses why. And my argument is, if you're making those excuses why, you should look at how much TV time you're watching, or how many drinks are you buying at the bar, or what are you doing on your weekend that you could carve time out of? Me and my wife, we work 60, 70 hours a week, and we've been blessed that we've been able to get into some angel investments, and we trade it. And it's a lot of balls to juggle, but we make it work because we prioritize time. And we know that over time, if we do that, then the back end is going to be very successful. And so what I would challenge you to think about is, if you're beginning as a trader, then just learn. And that's all you can do. It's okay if you don't know anything, but just learn. If you're a seasoned trader, then you know what you know, and isolate on those items and continue doing those well, but also pick up new tricks. So I'm not the type of trader you're going to see in the chat room trading 5-minute charts, because I'm just not good at it. I can do it, but it's a struggle for me to do it. If you want to swing trade 45 days options, I'm your guy. But I know what I'm good at, and I know what I need to learn. So I'm not going to throw real money at a 5-minute chart and take a 4-digit loss because I missed something on a level 2, or I missed one small candle of volume that actually made up 30% of the trading volume for the day. that I just happen to miss over, and then I take a loss because I missed a rubber band opportunity or something like that. My point being that if you always warn, you stay realistic about it, you're going to be successful at those. And so that's my journey. So Clay, what questions do you have?
And that wraps up episode 181, part 1. So if you want if you want part 2, that'll be next week, episode 182. I realize we kind of just left you a little bit on a cliff, but hopefully you're saying, oh, please give me more, because that would be a sign that you are enjoying yourself, which I'm pretty sure that you are probably feeling that way, because I had a great time with it, and I'm just as confident that you'll find part 2 as interesting as part number 1. Part 2 will get more into his strategy and such. I know this one we spent a lot of time with his journey, but next week, episode 182, will be more of, like I said, his strategy and how he uses charts, but not only charts, but takes fundamental aspects and kind of blends the two together, and he blends them together in very logical ways. So there will be a lot to learn, and to kind of little nuggets of wisdom from experience to gather next week too. Before we go though, a final few things. First, if you are listening on the YouTube channel, be sure to check out the channel as a whole. A lot of other videos besides just this one, live trades, quick tip videos, there's vlog videos, a lot of different variety, so make sure to check those out. Hopefully you decide to ultimately subscribe to the channel. If you're listening on iTunes or any of the other podcast players, be sure to subscribe so you can keep up to date on the new content. Especially on iTunes, if you could leave us a rating, that really goes a long way and helps us out, so I would really appreciate that. Even if you never spend a dime on the site, totally fine. But if you enjoy these podcasts, then help us out, and an easy way to do that is just to leave us a quick rating on iTunes. And finally, if you're listening on claytrader.com in the show notes page, click that share button and you can leave us a comment down below. We will read those, and we will definitely interact with you. So again, thank you for hanging out, and we will see you back for next week, episode 182, which will be part number 2.
This has been the Stock Trading Reality Podcast. Thanks for taking the time to hang out. To learn more about Clay and the Clay Trader community, including the trading team, premium training, and more, visit claytrader.com.